My name is Michael Duke, and this is the show where I talk about stocks that are interesting. So if you find that interesting, please consider liking this video and subscribing to the channel. Today, we are going to be talking about LandBridge Company LLC, ticker LB. As usual, I'm going to give an overview of the company. I'm going to take a look at their financials, their valuation, if they pay a dividend or not. We look at that. Discuss some of the risks and do a technical analysis of the chart, and then conclude, as always, with a grade: buy, sell, or hold. This is not financial advice, and I am not a registered financial advisor, just a guy with opinions. So, without further ado, let's get into it. I don't hardly know anything about this company. The last video I made was about Kimball Royalty Partners. They aggregate and invest in mineral interests all across the country, and I understand that LandBridge is similar to that. So this video is going to be me discovering what they do in real time. I don't have a lot of prior knowledge. This was not a viewer submission, just something that came up, looked pretty interesting and relevant to the last video that I made. So let's get into it. This company went public recently. Looks like shares started trading on the New York Stock Exchange June 2024. IPO'd at $17 a share, 25% performance over the last year. I believe that is outperforming the S&P 500. One thing that looks interesting, we've got some pretty massive growth here. Some pretty massive growth over the last few years in terms of revenue. So what does this company even do? LandBridge, together with its subsidiaries, owns and manages land and resources to support and enhance oil and natural gas development in the United States. It owns surface acres in and around the Delaware Basin in Texas and New Mexico. Delaware Basin, of course, is, I think, a subset of the Permian. The company holds a portfolio of oil and gas royalties. It sells brackish water and other surface composite materials. The company was founded in 2021 and is based in Houston, Texas. LandBridge Company LLC operates as a subsidiary of LandBridge Holdings LLC. We see here in Seeking Alpha, we've had some very, very bullish analysts calls here. As somebody who invests in real estate and land, a company like this, knowing what I know about it, which is very little other than that description, that type of business model speaks to me because it's what I'm interested in, monetizing land. There's another company, perhaps I'll do a write-up on that one as well, Texas Pacific Land Corporation. This company sounds a lot like Texas Pacific, just a big landowner that makes all their money from monetizing land. I already opened up their website here. Just looked at this page. Empowering energy and industry through strategic land management. We actively manage our land and resources to support and encourage energy and industrial development. Land is critical to energy and broader industrial development. That's very true, especially with renewable energy. We know how much land solar energy takes up. I'm a huge advocate for solar. I think that it's very much a solution for holistic energy generation for the entirety of our needs. I believe that solar can do the trick. However, it has to develop organically. So to that point, I agree wholeheartedly that access to expansive surface acreage is necessary for oil and natural gas development, soil power generation, data centers, power storage, and non-hazardous oil field reclamation and solid waste facilities. We actively manage our land and resources to support and encourage oil and natural gas development. Open that tab for later. 277,000 surface acres in the heart of the Permian. So yes, it was Permian. That's a subset of the Permian in Delaware. Committed to environmental stewardship. I like that. That's sexy. Let's just read the most recent news. LandBridge announces strategic agreement with NRG to power potential data center. Potential data center. Site could host a natural gas power plant to provide scaled power solutions for a data center development. LandBridge company entered into a strategic agreement with NRG. Of course, NRG is a utility with respect to a potential data center site in Reeves County, Texas. The site could potentially house an 1,100 megawatt grid-connected natural gas power generation facility, which NRG could construct if an appropriate power purchase agreement for a data center is secured. Initial air permit applications and electric interconnection requests have been submitted, which would allow for an in-service date as early as year-end 2029. A LandBridge is strategically located surface acreage adjacent to the Waha gas market hub, provides direct access to substantial existing low-cost natural gas and transmission infrastructure, supporting regional development and future operation. So basically, they're saying, hey, this would be a good spot for a data center, and we would absolutely be willing to build a 1,100 megawatt, which is large, natural gas dedicated power generation facility if someone were to build a data center here. Okay, so that's interesting. It sounds very theoretical. It's quite the thing to make a press release about. Hanging H Ranch, which included approximately 72,000 surface acres, 4,000 mineral acres. So they've just bought a bunch of land. They're living the dream. Over here. Okay, here we go. Exactly what that land looks like. I don't know if you've ever been to that area, but yeah, it's the desert. Let's take a look at their numbers. I'm a little perplexed. A little perplexed at the business model here. They own a bunch of land. What are they doing with it? They say that they've got royalty interests. I like royalty businesses. It's a little bit more capital intensive here versus Kimball, what we looked at last week. Of course, Kimball only owns the mineral interest. They don't own the acreage, right? It costs way less money to buy mineral rights than it does the actual acreage. So what I'm surmising here is that not only are the mineral rights monetized here, but there's the optionality that comes with the remainder of the land. Kind of like how we saw here, that would essentially be a real estate deal. Right? Continued significant year-over-year growth. Revenue up 83%, adjusted EBITDA up 81%. That's very good. Based on what we know about what we saw in that last slide, it appears that I would think that's coming by virtue of acquisition, not organic growth, but we'll find out, or we'll attempt to find out. Record $34.2 million in surface use royalties and revenues driven by our acquisitions and organic growth. Non-oil and gas royalty revenue at a record 94% of total revenue. Interesting. We reached a 10-year surface use and pore space reservation agreement with Devon Energy, securing 300 barrels per day of pore space capacity with an obligation to deliver a minimum of 175,000 barrels a day at East State Line and Speed ranges. So that's extraction. Executed a lease option agreement with a large public IPP for the development, operation, and construction of a natural gas-fired advanced combined cycle gas turbine. Yeah. Energy and LB entered into a 10-year pore space reservation agreement. How about that? A pore space reservation agreement. 300,000 barrels per day. Pore space reservation will commence in the second quarter of 2027. Offers a long-term pore space solution along with new Texas Railroad Commission guidelines, facilitating transfer of produced water away from high-pressure areas to LandBridge. I think what that means is that they're storing water. They actually were acquired by LandBridge. I was thinking of coming back to that, but I saw that they're just getting bought out. So figured I would just neglect to return to that one. But this is what I'm realizing is that we got some water. I guess we talked about that here. It sells brackish water and other surface composite materials. So it appears that we are allowing the energy provider to deposit water on these ranches in the purple area. This is getting complicated. And then the CCGT project, service potential co-loaded data center load, this option agreement, evidences interest by power generation. Is that different? Oh, here we go. We anticipate providing further details as well as counterparty identity in a forthcoming joint press release. So that is the uh, press release we just read about with energy. I'm going to move myself over to the left. These are very, very interesting looking numbers. Non-oil and gas royalty revenue. So we've gone from 28 to 48 million over 4 quarters. Now you see there's some seasonality in the free cash flow. Adjusted EBITDA is also smooth like revenue. That's interesting. Our EBITDA margins are incredibly high. Free cash flow and free cash flow margin. That's interesting. That's interesting what's going on. There's some sort of seasonality to their um, profits for some reason. You see their revenue is not seasonal, but their cash flow is. That's interesting. Maybe it's CapEx. Maybe it's growth CapEx. Produced water royalty volumes. Got a huge step change of like 80% there. Must have been an acquisition. Brackish water sales and royalty volumes. Also a huge step change. Sand royalty volumes. Modest growth there. Oil and gas royalty volumes not really changing the revenue driver. This has reminded me a lot of again, ARIS, ARIS, but way more, but with all the land, not just infrastructure element. Royalties include produced water transportation and handling operations, oil recovery, and waste reclamation. This high percentage of gross revenues for the use of our land and volumetric use of infrastructure. Fees for development and use of drilling sites. So I'm just going to try to simplify this the way I'm seeing it in my mind. They own a bunch of land in basically the Permian Basin, which of course is ground zero for the U.S. shale boom and for oil and gas extraction. And they're monetizing that land very intelligently through a combination of oil and gas royalties as a minority versus surface use royalties and then resource sales. So they're actually, resource sales include brackish water used in well completions and caliche used in construction of aqueducts. So is the caliche, is that just like rock sitting on their land that they're crushing up and selling? Either way, they're monetizing the land intelligently, which is interesting. Royalties received for the extraction of sand and water usage. Fixed royalty per ton of sand extracted and a fixed fee per barrel of water. Of course, you know that some types of extraction take certain types of sand. Okay, this is quite the graphic here. LandBridge is critical to energy and broader industrial development. Diversified revenue streams driving long-term value with substantial free cash flow growth. WaterBridge, produced water handling facility. Processing. Our strategy represents a paradigm shift compared to the typical landowner dynamic. I like that. We strive to maximize commercial activity on our surface by actively seeking opportunities to collaborate with operating companies and developers. So they're saying, hey, we got land and we're open for business. We don't want to put up a fence and keep you out and just raise cattle on it. We want to maximize dollars per acre. Access to expansive surface acreage is critical for oil and gas development, data centers, solar power, generation, power storage, blah, blah, blah. Symbiotic relationship with WaterBridge, one of the largest produced water handling infrastructure companies in the United States. I think WaterBridge is the same as ARIS, the same type of company. Serves as an anchor for our business by fostering mutual growth as WaterBridge expands its water infrastructure across our acreage. So WaterBridge is one of the operators. City. on top of LandBridge land. Saying, hey, look at us, we're the best. Royalty business model for revenue generation that scales with producer activity, demonstrated ability to add and further diversify revenue streams, fee-based revenue streams with commodity price upside, limited OPEX and minimal capital expenditures, results in high margin, highly capital efficient, asset-light business model. This reminds me a lot of, yeah, there's like that asset-light aspect to it. I got to be honest though, my lack of knowledge about energy how this industry works is really holding me back from being able to understand this at a deep level. LandBridge offers the industry a differentiated pore space solution, ideally located contiguous pore space that is not burdened with the higher pore pressures prevalent in other areas. Pore pressures prevalent in other areas of the state line. Relationship with WaterBridge and other midstream operators enables strategic transportation of produced water away from areas with high pore pressure or regulatory constraints to underutilized pore space on our acreage. Development approach aligns with recently released Texas Railroad Commission regulatory guidance focused on preventing irresponsible pore space. LandBridge is focused on not over-concentrating water disposal assets and maintaining pore space integrity over time. See, because I'm not a geo engineer, a lot of this stuff is going over my head. I find it fascinating though. We intend to use our significant and growing free cash flow base in a balanced and sustainable manner to create value for our shareholders over the long term. Our free cash flow will generally be employed to maintain an appropriate capital structure, net leverage ratio of 2.4 times. So we target between 2 and 2.5 times, support financial flexibility and ability to pursue and use return capital and value accretive acquisitions. We like that. Return capital to shareholders. There's a dividend. And then they're saying, yeah, maybe in the future we'll buy back shares. Opportunistically pursue value. Significant opportunity to acquire underutilized and undercommercialized land in a fragmented market. That's certainly true. You see that land. That land isn't exactly screaming of value. This is everything. Access to renewables, access to water, fiber optic, commercially market. So basically they're saying, hey, nobody's building data centers on our land right now, but data center developers should really like what we're dealing with here. That being said, we don't have the agreement in hand. LandBridge, okay, this is interesting. LandBridge, active surface manager that promotes efficient industrial development of our land and resources. Receives fees and royalty streams for WaterBridge operations on our land. Receives surface use payments for any infrastructure built on WaterBridge on our land. WaterBridge is a significant customer in our agreements of activity on our surface. Shared management and sponsors support ongoing alignment of businesses. So in other words, that I think WaterBridge is owned by, it's controlled or it's a subsidiary of LandBridge Holdings LLC, right? Shared management and sponsor. OpCo, PropCo, a cross-pollination of revenue. That's a double-edged sword. It cuts both ways. It can lead to monstrous growth because they're playing monopoly with house money, right? But if there's too much mutual interdependence and headwinds arise, it can double the risk, right? Something to keep in mind. I can't clearly visualize what type of structural risk this sector would face in the immediate future that would create that. Again, I'm not much of an oil and gas guy, but what I do see is, they're operating in an area and in a business that is experiencing very heavy activity, despite the fact that oil prices are. Funds affiliated with 5 Point and LandBridge manage have a 3/4, 1/4 economic interest in LandBridge Holdings, which has 67 or 2/3 over. So they have all of the Class B shares. and effectively control LandBridge LLC, LandBridge Company LLC, the public shareholders of which have 33% voting power. Incentive units. Incentive units provide meaningful alignment between management and Class A shareholders by offering management an indirect economic interest in LandBridge. This reminds me kind of Clearway Energy. Well, their numbers obviously look very good, and their EBITDA is very much looking phenomenal. There's this interesting cyclicality over the history that we have here. I'm not necessarily concerned by their capital structure. I don't find it a problem when you have this type of setup, but yeah, one thing that we don't see here is it's definitely set up in a way that creates deliberate control. One thing that we don't have in this entity here is we don't have a breakdown of voting interest or control interest. Perhaps it's implied that the funds have a 77% of the vote in this entity, and 23%. But it's also possible that this is a GP-LP setup where LandBridge management is the GP, and therefore they control this entity, and the funds are passive LPs, so they have the majority of the economic interest, but none of the control interest. If that were the case, I would probably like it more. I'm a little confused maybe why they didn't specify that. Perhaps they felt that they didn't have the room on this slide. But I would urge my viewers to look into that more in your own time. Maybe make sure you're comfortable with the way that this looks. I think it's not crazy convoluted or anything. It's just that definitely explains what I had a question about when reading the description. Oh, this looks great. This growth is good. What I don't necessarily understand, and probably won't come around to understanding until the end, until after I do more research on this. This is complicated enough that it's not simple for me to grasp. It really is. But obviously, based on what I know about what they own and what their margins are, I definitely can tell that it is very asset light. That the business model itself is very strong. What I am struggling to grasp is what I'm correlated with, and therefore what my risks are. In other words, obviously we have some exposure to oil and gas prices, so we know what the risks and rewards of being exposed to the commodity prices there are. But is that also how these work too? Like, is brackish water, does that price fluctuate like the price of a barrel of oil? Produced water, does that also work the same way? Based on a percentage of gross revenues from the use of our land and our volumetric use of infrastructure on our land. It's a good model. Fees for development and use of drilling sites. Fees typically received when the contract is executed as monthly or annual payments at the start of each renewal period. So we don't necessarily need to drill down too much. I guess I just want to reiterate that, Wheaton Precious Metals, the precious metal streaming company that I've covered on this channel, that I really like. They have a royalty-based, model, and very high margins and very leverage on the gold price. I can very easily and simply explain to you that when the price of gold goes up by 10%, the cash flow of that company goes up by 10%, more than that, right? There's it's very simple arithmetic. This is more complicated. Therefore, it's hard for me to get as excited about something that is more complicated like that. But it doesn't mean that it's not exciting. in and of itself. My judgment is not the end all be all of things, of course. Um, so the growth in their numbers looks really good. It would be great to understand the breakdown of what growth is coming from acquisitions versus organic. That would be I'd be very curious to see that. If I can distill this down to what I do understand, where it's, royalties include produced water transportation handling operations, so they're, a percentage of the economic value, resource extraction, or volumetric use of infrastructure set up for space. That's a pretty sexy business that I like. So you see, here's all really the theoretical uses that they can pull from their land. One thing I will say is that they make so much. They're really trying to hype up this like data center thing, but everything I see about the data center aspect is theoretical. It's not real. Whereas oil and gas or oil and gas ancillary business appears to be all of their business. And yes, they say, oh, it's 94% of our revenue is non-oil and gas. Well, brackish water, they're being very technical with that term. Brackish water is oil and gas, non-oil and gas royalty revenue, right? So that's kind of a technicality that they're saying that. So their growth looks really good. Their numbers look really good, albeit I'm a bit perplexed by that, just given my background and lack of knowledge. So that we know that they're growing fast, that they own land that is hot. It's strategically located land in today's current moment in time, given the Delaware Basin's strategic importance to United States energy production. How does the valuation look? On a non-GAAP basis, trailing 12, 69 times earnings. Forward, we're at 27. I would think that price book value, would be um, a good way to value a company like this. Again, given that what it appears like they are is really a top, best in class land bank. They would hate to be described as a land bank, but yeah, they own them. Price book of 5.35 is exceptionally high. I mean, that's exceptionally high. Price sales 7.5 times. Price cash flow on a trailing basis 16 times. We got a less than 1% yield. Valuation is absurd. I mean, we have an F grade in Seeking Alpha. I tend to agree. I mean, there's not only do I not really fully understand what the business does, I don't understand the valuation. Enterprise value over EBITDA 26 times, trailing 12. I've bought companies more. I think again the wheat and precious metals company was more valued higher than this on all these metrics. However, I understand what drives earnings growth on that company. I understand again the price of gold and silver goes up, earnings go up. Volumes go up, earnings go up. Both things happen, earnings go up a lot. It's very simple for me to see that. So I can look at forward-looking numbers that are on growth assumptions that are really aggressive and be like, yeah, I understand that. This because I don't understand what drives volumes of brackish water. What I don't understand what drives volumes of this surface royalties and stuff. Because I don't understand that, I don't feel comfortable with this valuation. Therefore, not only is it objectively absurd to me, but it's subjectively absurd as well. So I don't want to say it's overvalued. It's expensive. It's very, very expensive, for sure. I think we forgot to look at their balance sheet. Do we have their balance sheet in here? No. Of course, we know. This has an impact on their balance sheet. Let's just pull up their balance sheet here. So, as of the last report, 939 million real estate before depreciation. You notice how little depreciation is accumulating. That gives you an idea that it's a lot of just land that's sitting there. There's not a lot of buildings. There's hardly any improvements on the land. I guess that's not surprising. 20 million of cash and 20 million of AR, so 40 million of current assets, another 3.2 of current, 43 million of current assets, current liabilities 1.1, current portion 0.2. So they have 371 million of long-term debt. However, they have more than enough cash and AR to cover current liabilities, so their balance sheet in that regard looks extremely healthy. They've continued to issue shares. And we see here book value per share. Book value per share at the time of IPO, I believe that the IPO occurred in this quarter here. Book value per share was exactly the IPO price, roughly. Book value per share has not really accreted. Yeah, you see right here the buildings. 5.2 billion worth of buildings. And how about this? 4 full-time employees. Super bizarre balance sheet. Yeah, I think again the main thing to worry about is current assets, current liabilities. There's more than enough there. That doesn't take into account their cash flow. But we know, at least on paper, they're profitable. So in that regard, I would expect retained earnings to be increasing, and sure enough, that's what's happening. In fact, we are retaining quite a bit of earnings. So balance sheet and the cash management, the financials look phenomenal of this company. The valuation is absurd. I think objectively high, even with optimistic growth assumptions. 27 times for a land company, I think is crazy. I mean, land has very low earnings, low single-digit margins. Let's remember where this land is. If it were not for energy generation of this land, it's some of the worst land on the surface of anywhere in the country. It's incredibly dry. Um, it's not good pasture land. It's not good non-irrigated pasture land. It's not farmland. The energy angle of the land is what makes it attractive. So it's not. This isn't the Taj Mahal that they got sitting on this land. It's not like premium real estate that's in a central location. It's on main and main as far as energy generation goes, and that's it. So from that standpoint, um, I find it really hard to justify the valuation. But that's with the caveat that I don't fully understand a lot of the drivers of the underlying business. I'm going to learn more about that and perhaps come back to this video. I'm certainly going to write an article about this company, and by the time I submit that article, I will have educated myself on how things work. So make sure to follow me on Seeking Alpha and read the article so you find out what I conclude from that. So I want to talk about the risks. I think really the main risk I see here is just the fact that so much optimism has been baked into the price that it just seems ridiculous. And you also have this, the management keeps talking up this data center angle. At least that's the impression I get from the earnings presentation. August 8th, I think, was their earnings. Yeah. That's the impression I get, and I just don't really see where maybe the data center upside materializes. Maybe it doesn't. I don't want to take a flyer on something that you know we're so far out from that. You even see that here. Harrison Schwartz wrote on September 17th. about the company, reasonable valuation, but clarity on non-oil projects is lacking. I think that's true. Again, we've given this a very brief once over, but yeah, I think that is the case. So there's a lot to like. There's a lot to like about this company as a concept, as a business model. There's a lot to like about it, and a lot of reasons, to get on board with it. But I think we need to ground ourselves in reality, and I'm just not sure that the shares are grounded in reality. And I think that that's the risk, is that it is trading at what I believe is a nosebleed valuation. It does have very, very good growth, so there is that. Um, but I see, there's a lot of things that can go wrong when, at least in my experience, when you look at a company like this and you don't fully understand what they do, but you're like, oh, this is such a high flyer, it's so sexy, it combines all of the things that are sexy in today's market, and surely it'll go up, right? That's not. I would not recommend, placing capital with that thesis. So that's the risk. Is the main risk I see is just the valuation, and um, it does imply the valuation does imply, that there's certain things that need to occur uh, for that valuation to be justified. As Mr. Schwartz says, the clarity on that is lacking. Whereas if it is it priced purely as an oil and gas infrastructure company, it does not appear so. In which case, there is some middling performance expected, perhaps. And you also see there's just a lot of volatility in the shares. We're trading between $80 and $50 on the regular. Back in May, it was 84, $85 a share, and we've traded all the way down to 50, and we've since recovered another 15% since then. So we've got a lot of volatility in the shares. Let's just take a look at the technical analysis before we conclude. Myself back over. So since IPO, very, very bullish for the most part. Kind of traded in this like ascending wedge platform. And after the May earnings, it appears, well, really, in Liberation Day volatility, we traded below that. We recovered back, but bounced off of our trend line resistance level that was ascending slower than our low was ascending. So after the May earnings, we broke down below that, and we've entered into this different consolidation here, which doesn't really have much of a clear pattern here, other than there isn't really much to surmise. I mean, you could draw the top line here a couple of different ways. All I do know is that we've where we're at now. These are 1-day charts, 1-day candles. Excuse me. Where we're at now, we've hit that resistance. We're on our third iteration now. We've bounced here. So each time we've kind of been in this wedge formation where we've had, uh, you know, here we were ascending slower than we were ascending slower on highs than lows, and then here we're seeing lower highs and higher lows, which is neither bullish nor bearish. So um, honestly, not a great looking chart. Not a great looking chart, because here it was like the valuation got overextended, and even at this lower area that we're at now, the valuation looks a little absurd to me. So I can't even imagine what it was like up here. I do find this the current level it's at to be just challenging of an entry point. If you look beyond all the concerns, valuation wise, and you say, hey, this looks like a good investment, um, you know, and you're ready to enter, I find the chart to be tenuous here. Just given that there really is no clear, there's really no clear pattern other than this is our support line, and we're at the top of a range bound motion that doesn't really have a good looking trajectory upwards. Now, of course, we're on the cusp of that. The price is green today, and we're up 70 basis points today, largely in line with the market, I believe. Um, who knows? Maybe in the next couple of days we could break out of that, and everything I'm saying is kind of a milky toast uh, judgment on the way the chart looks. However, right now I look at this and I say, ooh, yeah, not only is that valuation challenging, but this chart doesn't really know how it wants to behave. Therefore, there's too much up in the air. So that being said, I think there's a lot to like about the company. I think it's worth more analysis. It's worth a much deeper dive into certain aspects of it, particularly the capital structure, or excuse me, the management structure, um, and uh, just I think it deserves more time for some of these like more upside prone theses to play out. Um, but I could see a lot of reason to be optimistic about the company. However, I'm just not drinking the Kool-Aid. So for me, it's a whole. I think there's enough of redeeming qualities to make it look interesting and sexy. But I think that the current valuation is just a little leaves a lot to be desired. That being said, perhaps if I understood the underlying business a little bit better, I could be more bullish on it. So I'm going to learn more about it, and we'll see where we go from there. And that will definitely show up in my article. So, anyways, that's going to conclude our video for today. Hopefully, you found this interesting. I've certainly had a good time going over it with you. Leave me a comment, review, what have you. Let me know how you like my content. And please consider liking and subscribing, continuing to support. We just crossed 400 subscribers. Thank you to all my viewers out there for watching these videos, as I very much enjoy doing this work on behalf of you, on behalf of everybody. So thank you again. Excuse me. Thank you again for watching. And until next time, hope you have a great rest of your day. We'll talk to you soon. All right. Thank you and good afternoon.